This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 352 was produced on December 1st, 2022. I'm Eric Townsend. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Rosenberg Research founder David Rosenberg returns as this week's feature interview guest. Rosie says this bear market isn't over yet and warns that past bear market rallies have ended at or near the 200-day moving average, which the S&P just moved above this week. He says inflation has already peaked, but cautions that doesn't necessarily mean the Fed is going to pivot right away.
And I'm Patrick Ceresna. Listeners, be sure to stay tuned for our post-game segment after Eric's feature interview with David Rosenberg when Eric, Nick, and I discuss the charts on the S&P 500, NASDAQ, gold, and the junk bond markets. We'll also touch on hedging option strategies to consider for protection of your portfolio. Now, Eric, before we move on to the feature interview with David, let's cover crude oil, starting with those EIA inventory data.
EIA reported a gargantuan 12.6 million barrel drawdown, and that's against consensus expectations of about a 2.5 million barrel drawdown. So it was a 10 million barrel beat on expectations. And that's really a 14 million barrel drawdown when you include the 1.4 million barrels that was drawn out of the SPR this week. Cushing, Oklahoma drawing down another desperately needed 415,000 barrels. Gasoline building 2.8 million barrels. Distillates building 3.5 million barrels. U.S. production unchanged at 12.1 million barrels. Now, the tape action was really interesting in reaction to inventory. There had been an earlier rally, actually the completion of the last couple of days rally, about $7 increase in the price of WTI, and that came on the back of news that China had begun to at least make some steps toward easing its zero COVID policies. But the market actually put the high on the day in before the inventory numbers came out. That was right at the 13-day moving average on Wednesday, which was co-located with the 38.2 fib retracement, right around 81.27 on the WTI front-month contract. The incredible huge size of the crude build didn't even bring on a retest of the high of the day at the 13-day moving average, never mind moving substantially higher than that. And expectations, again, were only for a 2.5 million barrel draw. We saw a 10 million barrel beat on that for 12.6 million barrels, and then another 1.4 coming out of the Strategic Petroleum Reserve. So it really feels like this market has run out of steam to the upside, or perhaps more accurately, this market is waiting to see what comes on Sunday at the OPEC Plus meeting and then Monday when European sanctions take effect on Russian oil. Regular listeners know that until very recently, my view has been that we were close to reaching a bottom in the market, and China reopening news would be the catalyst to reverse the trend to the upside. As John Maynard Keynes famously said, when the fundamentals change, I change my opinion, and the fundamentals are definitely changing. But if anything, the picture's getting cloudier, not clearer. So let's review the basis for my prior thesis, and I'll explain why my directional conviction is diminishing. I've been consistent for months and months now in saying that a global recession is likely, and that's obviously bearish for crude oil demand. I've warned that this would take the market lower before it could move higher, and so far that's exactly what's happened. I've also observed what was an incredibly tight physical market, and I've said that tight supply could actually be a bigger concern than admittedly weakening demand. For these reasons, I've predicted crude prices could move higher even in recession. The four specific indications of a supply-constrained, tight physical market were as follows. Number one, generational lows in crude oil inventory, both commercial and strategic reserves, and that just got even more generationally low with this week's print. Number 2, extreme fear of supply exhaustion indicated by historically unprecedented backwardation in the crude oil futures curve. Number 3, unsustainable strategic petroleum reserve drawdowns by both United States and China, creating temporary supply which cannot be maintained long term. And finally, number 4, widespread expectations among analysts that China's full economic reopening was close at hand, meaning that supply constraints would soon be tested by an upward spike in Chinese demand. The big change has been an outright collapse in backwardation in the futures curve, with the first 2 WTI monthly time spreads now in contango, and the next 2 months just barely holding on to weak backwardation. This is a really important signal, to my thinking more important than the weakness that we've seen in the flat price. If the switch into contango at the front of the curve is sustained, it's often a reliable bearish sign for what's to come next for the flat price. With so many moving pieces and so much news flow, the jury isn't out quite yet. But if the collapse in backwardation doesn't reverse and reverse soon, it definitely changes my opinion about how tight the physical market really is. On the other hand, global crude oil inventories are very definitely still at generational lows and just got to new lows this week. And these are not conditions normally associated with sustained bear markets in crude. But the fact that even a gargantuan 14 million barrel draw on U.S. inventory wasn't even enough to bring about a new high on the day after the data came out is quite telling. It means that the market isn't as concerned about record low inventory levels as I think it should be, and frankly, I'm at a complete loss as to explain why. Normally, when backwardation collapses, it's because inventory is recovering, and the market's fear of insufficient supply to meet demand is collapsing because higher inventory means more oil is available to meet demand. That's not what's happening here, at least not according to the data that's been reported so far. All I can fathom is that increasing popularity of the global recession is coming view that I first expressed months ago is outweighing very real signs that inventory levels are at, frankly, scary low levels. Or perhaps maybe somebody knows something I don't and thinks a huge amount of new supply is about to come into the market to replenish these low inventories. The China side of this story is even more nuanced and even more confusing. Over Thanksgiving weekend, protests erupted across China over zero COVID policy. Now, protests across the entire country, and especially where people were being so bold as to chant in public, down with Xi Jinping and down with the Chinese Communist Party, that's something we really haven't seen since Tiananmen Square in 1989. So there's no doubt in my mind that the reason crude oil futures sold off and sold off hard at the Sunday open was fear that Chinese protests could lead to Xi's leadership being challenged. But then China held a press conference. The rumor that moved crude well off its lows was that China was about to announce an end to zero COVID. Now, they didn't actually announce that, but they did announce steps such as rushing vaccinations for the elderly, which analysts are interpreting as preparation for being able to bring an end to zero COVID policy soon. That news is what caused the $7 rally in crude oil to test its 13-day moving average and the 38.2% fib retracement of the move down from mid-November on Wednesday, just before inventory was released. But then that incredibly large inventory draw failed to extend that rally higher, as I would have expected it to. The next big consideration is OPEC+, which meets on Sunday in a virtual meeting. My own strong opinion is that OPEC+ should make further cuts to production. Their job is to stabilize the market, and they're almost completely out of spare capacity, which is their ammunition to stabilize the market when China eventually does reopen fully. So they need to be rebuilding spare capacity right now, and a cut into present low price levels would accomplish that. Quite a few analysts agree with me and have predicted an announcement of further cuts coming in Sunday's meeting on December 4th. But there's one big lingering question in the back of my mind. Why did President Biden suddenly and unexpectedly vouch for Mohammed bin Salman by telling the court system in the United States that he should be immune from the Khashoggi murder lawsuit? Now, it feels to me like there must have been some quid pro quo or promise that was made in order to get Biden to do that. And if there was, what was it? Remember, a cut requires unanimous vote of OPEC+. So any one member, including Saudi Arabia, could single-handedly kill an effort to announce a cut if they didn't want it to happen. Lots of mixed signals here. Overall, I still see plenty of reason to think the coming recession won't hurt crude oil prices as much as the macro analysts who don't understand the physical market seem to be betting. But the collapse in backwardation is a really, really big deal. And until that changes, I'm much less ready to make big bets on a massive price rally when China finally does announce its reopening plans. So I'm flat and waiting to see what happens next.
Well, this week's feature interview guest is Rosenberg Research founder David Rosenberg. Now, Eric, why did we get David on the show this week?
Well, Patrick, Rosie has been one of our most popular guests with listeners. He's a legend in the industry, and he's generally favored a deflationary view over inflation the last time that we interviewed him. So I wanted to get an update on whether that's changed and find out what he sees coming next.
Well, Eric's interview with David Rosenberg is coming up as MacroVoices continues right after this message from our sponsor.
If you invest to bring about a world powered by green energy, you should meet Respect Energy, a leading European trader of renewable energy that serves as a one-stop shop for green energy investors in Europe. Respect Energy brings together independent power producers, accredited and institutional investors holding assets in renewables, or undertaking investments in new green energy production, such as wind and solar photovoltaic power plants. More than 600 institutional and accredited investors have already entrusted Respect Energy with the sale of their electricity production, portfolio management, O&M services, EPC, and project development. If you want to invest in green energy in Europe with the help of a trusted partner, contact Respect Energy today and ask for a tailor-made solution. For more information, visit respect.energy.
And now, with this week's special guest, here's hedge fund manager Eric Townsend.
Joining me now is David Rosenberg, founder of Rosenberg Research and author of the legendary Breakfast with Dave newsletter. Dave, it's great to get you back. Obviously, the question on everybody's mind is the bottom in? Is it just a bear market rally? Where are we headed from here?
Well, I think that we've had a few bear market rallies this year, not unlike the bear market rallies that we had through a good chunk of 2001 and 2002. And back in 2008, we had some of the most powerful bear market rallies. And these are bounces that are fun to trade. If you think you are Paul Tudor Jones, then go right ahead and trade them. Each one of these has actually failed at or close to the 200-day moving average. So if you're watching the technicals, you can trade the market in a bear market, trade it from the long side for a period of weeks or months, and you can do rather well so long as you have your exit strategy and your hedges in place. But yes, of course, this has been another bear market rally. And I say that because if we're willing to acknowledge that we're heading into recession, you see, this is a case where your assumptions end up drawing your conclusions. If your conclusion is that we're going to have a soft landing, that we're going to have slower growth but no recession, then the lows have been put in. And you want to buy this market on any dip. That's not my view. My view is that we're heading into a recession. It wasn't the first half of this year with the back-to-back quarters of negative growth. That was the pernicious impact of the shock from food and from energy. But the real enchilada is going to come next year as we get the full brunt of all the lags of what the Fed has already done. And so the one thing I know about history, and I think one of the best quotes of all time came from Warren Buffett, when he famously said that what we know from history is that people don't learn from history. But we know that although there's not an alarm bell that goes off right at the market low, we do know that there are patterns that constantly reemerge in a recessionary bear market very close to the trough. And I'll just give you two of them to start off. The first is that in a recessionary bear market, the market bottoms 70%. Call it the seventh inning of the recession. The market bottoms as the recession becomes more commonplace, more priced in. And at that point, at the lows, what the market is doing is pricing in the ensuing recovery. So I just say good grief to anybody who thinks there's going to be a recession, but is buying the market thinking that it's hit a trough is a classic case of cognitive dissonance. Because if we have a recession, it's only now just starting, or will start in the opening months of next year, and you want to buy the market deep into the recession. We're not there yet. Second point is tied to the first point, which is that you want to buy the market, and I mean dive in for the next cycle, not a bear market rally, not a tradable rally, but a new cyclical bull market. They happen when the Fed has cut interest rates sufficiently to re-steepen the yield curve. The yield curve right now, and I'm looking at the 2s10s curve, but every curve is inverted right now. 2s10s are inverted by almost 80 basis points. There has never been in history a period where the market bottomed as the Fed was still raising rates into an inverted yield curve. It just doesn't happen. If you want to trade the market or become an investor saying it's going to be different this time, it reminds me of Harry Calloway, in the famous Dirty Harry films from Clint Eastwood saying, "Do you feel lucky, punk?" The reality is that the market bottoms for good, not just 70% into the recession, but 70% into the Fed easing cycle. Well, this Fed is still tightening and raising rates into an inverted yield curve. Historically, when we get those lows in the stock market, again, in the context of a recessionary bear market, which I think we are heading into, the 2s10s curve has steepened to a positive shape of 140 basis points. Now, I'll tell you, we will get there. It's a matter really of when. And it might not be until we're well into the second half of next year, because this Fed doesn't look like it's set to turn anytime soon. But you need the yield curve to shift out of inversion towards a positive slope in the context of a Fed easing cycle. Remember, they say don't fight the Fed? Well, for people that think that the market's bottomed, I ask the question, why are you fighting the Fed? It didn't pay to fight the Fed when they were cutting rates and easing policy through most of 2020 and 2021, but all of a sudden, we're supposed to believe that a bottom in the market is at hand as the Fed is still raising interest rates into an inverted yield curve. It boggles the mind, but it goes to show how desperate everybody is to have this bear market end. But the sad reality, and this is a case again where my grandmother told me as a young lad, forewarned is forearmed. We have yet to see the lows. And we could be down at least another 20 or 30% from where we are today before we get to those lows. And that probably will not happen given the Fed's posturing until we're deep into the second half of next year.
I was particularly curious when you said you don't think that the Fed is anywhere close to reversing policy, because something that I've noticed in interviewing so many different people is what I perceive, frankly, to be almost a delusional obsession with this Fed pivot idea. Everybody is just, holding their breath, waiting for the Fed to pivot. I don't understand why. What do you think is going on here, and what should we expect in terms of how the Fed is going to manage monetary policy?
Well, look, it's a classic case of hope triumphing over experience. I think that we have to define what pivot really means, especially for the markets. Right now, pivot could be described as, well, the Fed no longer tightening 75 basis points. At the same time, it's reducing the size of its balance sheet by $95 billion a month. We'll put that aside. That's another form of tightening that also has financial market considerations. But what is a pivot? People talk about the Powell pivot in 2019, But that pivot, well, it took about 7 months to unfold after the Fed was finished raising rates in December 2018. The pivot historically is we're going to shift to cutting rates. That's a pivot. A pivot is not slowing the pace of rate increases from 75 to 50, 50 to 25. The Fed is still raising rates, even though it's not pernicious 75 basis points any longer. They're still raising rates into a yield curve inversion. And I think you're 100% right. The real pivot, the pivot that matters, that should matter most for the markets, is the pivot that actually triggers interest rate declines and decline sufficiently to re-steepen the yield curve. So believe me that when it comes time to pivot for good, the market will probably once again have a bear market rally. There'll be lots of enthusiasm. But we have to have the Fed dig us out of this hole in terms of the inverted yield curve. It's subject to a lot of controversy and debate. It is every single cycle. People have always asked me if I had to be alone on a desert island, and there are a lot of people that wish I was, what would be the tool that I'd want to have with me? And it would be the yield curve. It is tried, tested, and true. I'm not going to say it's infallible, but it is the best leading indicator there is. And we need that yield curve to re-enter a positive shape led by Fed rate cuts. Remember, it's all about interest rates. Don't fight the Fed. In the initial stages of the interest rate cuts, which are inevitable, the question is, do they come in the second half of next year? We have some people on the Fed, I think it was maybe John Williams or Barkin, that had indicated that the Fed will start cutting rates in 2024. Of course, they'll be cutting rates again. People think, well, they'll never cut rates again. They'll never cut rates again. Of course, they'll cut rates again. And it's a matter of when it's going to happen. The Fed's telling you it's not happening anytime soon. They clearly are not happy with the level of inflation, notwithstanding the fact that it's rolled over. They're not happy with the current state of the labor market, even though there's some signs of loosening up. I don't think they're very happy with the state of affairs in the financial markets. I think that the Fed is very frustrated that any time that they even give a hint that there could be a subtle shift in policy, the stock market just goes bonkers. And I think that the Fed wants to break the markets free from its constant focus and attention on what the Fed is going to do next. I think maybe that'll be the time that the Fed actually feels comfortable pivoting is not going to be some economic statistic. It's not going to be some major event. It's going to be, for the first time, the Fed actually says something dovish and the market doesn't care. That might be the important signpost. But as for the here and now, you're quite right. Pivot is not slowing down the pace of increases in an inverted yield curve. A real pivot is not even a pause, although a pause will be important because we all know that once they pause, the rate cuts usually come about 6 to 7 months later. But that's how long you're going to have to wait. When people talk about the pivot that follows the pause, the pivot that follows the pause, the real interest rate declines, happens about a half year after that pause takes place. So it'll be a classic case of waiting for Godot. And so this will happen. It'll take a long period of time. Keeping in mind, remember, the Fed hasn't even paused yet. And the lag historically, and again, in the context of a recessionary bear market, and this is important in terms of trying to time when to start going long again for good, when you can go long and sleep at night. You're not trading the market. You're in a new cyclical bull market. That the lag between the Fed pause and the lows in the S&P 500 is 16 months. And the Fed hasn't even paused yet. Maybe they'll announce a pause in the opening months of next year. But those are the lags. And as we're all focusing on what the Fed's going to do or not do, we have to remember that although this year was the year of financial turbulence because of what the Fed did, next year is going to be the year of the economic turbulence. As all the interest rate resets take place and the very big impact, the peak impact of what the Fed's already done hits home in the economy. and then all the spillover impacts it has on asset prices, home prices, credit defaults, so on and so forth. That usually happens in the year after the Fed has finished raising interest rates. So for people that are there saying, I can't wait for the Fed to finish raising rates, I can't wait for the pause, let alone the pivot, just remember that all the bad smelling stuff happens in that period after the Fed is done tightening. And then the time to go really long the market is only when the Fed has cut rates sufficiently to re-steepen the yield curve to a positive slope. I come back to that because it's at that point where the market sniffs out the recovery. Well, I mean, that's like 2 or 3 chapters ahead of where we are right now.
Continuing on the theme of hope trumping experience, something else I noticed this month is we got in a famously noisy data series of CPI inflation. We got one print that's finally going maybe in a reducing direction, and all of a sudden, all kinds of people, smart people in the industry who've been around long enough, frankly, to know better, are declaring, okay, that's it. It's clear the inflation has peaked. There can be no doubt. Inflation's headed down from here. Should we be assuming that? I know you've had a deflationary view in the past. Should we be thinking that inflation has really peaked, or is it an unknown?
I think that there's no doubt in my mind that barring some new, unforeseen global supply shock, that inflation has peaked and it is rolling over. And I think in the next 12 months, it will decline rather precipitously. I know that's a controversial view. It's not a view shared by Fed officials or former Fed officials. I was put to task on this earlier today, where a Fed official had said that inflation ran up like a balloon and it's going to only come down like a feather. I'm not so sure about that. And it's not really about the CPI. The CPI, as Alan Greenspan famously called the CPI in 1996, a flawed statistic, because it is. I mean, 30% of it is rent. 40% of the core is rent. And it's not rent in real time because there's lags, because it includes all the renters that took on leases in the past couple of years. But we're seeing now in real time that rental rates are coming down. This will have an impact in the opposite direction in the next couple of years. But that'll be a frustrating source of my view, is that the rental component will certainly mitigate a huge decline in inflation. Be that as it may, the swing factor always is what's happening on the goods front of the CPI, the basic materials, the things you can see, touch, or feel, appliances, furniture, clothing, building materials, carpets. And you're going to see, and we're already starting to see it in the import price data, we're seeing it in the early stage producer price data. It's so evident that we are going into a deflation as far as commodities are concerned. Oil is down 35% from its highs. Copper's down 25%. The Baltic Dry Index, which is the poster child for global supply chain problems, which got the ball rolling on the big inflation, that metric, which is a proxy for global freight rates, has collapsed 60%. So, of course, inflation is rolling over. And 40% of the CPI is not exactly a non-trivial share. And as we saw in other cycles, when you get the big decline in inflation, it's not usually coming from the services side, which tend to be sticky. Healthcare services don't tend to go down. Education services don't tend to go down. Rents don't typically deflate outright. 100% true. That's not what triggered the deflation we actually saw back in 2009. It was the good side, that 40% that is basically material. And I think that is going to be a major driving factor in producing a bigger decline in inflation. Now, look, inflation, we're talking about a process. It's like inflation, for an economist, it's an exciting race. It's a race between watching grass grow and paint dry. But I do think that the next 12, 24 months, the inflation is going to unwind. And I'll tell you, just look at the money supply numbers. All the monetarists that were saying, look at the money supply 2 years ago, look at the money supply. The money supply boomed, and we got a boom in inflation. The money supply numbers are now either stagnating or contracting. M1, M2, the monetary base. The Fed has done a lot of work here. And my sense is that we're also going to have a very large loosening in the labor market. Remember that the Fed has already told us that its forecast for next year is the unemployment rate to go to 4.4%. We may get an update to that at the mid-December meeting. I think we're going closer to 6%. But of course, a lot of assumptions on the participation rate and the like have to go into that. But the Fed already told us that we're going to 4.4, and we bottomed at 3.5%. So the Fed itself is telling us that as low as the unemployment rate is, it's going up. And it's the change in the unemployment rate, not the level, the change that dictates the future of wage growth and the economy. You've never failed to have a recession with the unemployment rate going up 0.9 of a percentage point, which is the Fed's latest projection from its September meeting. Well, what do you do for an encore? So that's also going to have a leading impact on wage growth. The only question is going to be, and I think you worded it appropriately, is not whether inflation has peaked. Really not whether, the October CPI was an anomaly or the start of a new trend. I think it's the start of a new trend. It has to start somewhere. And all the leading indicators of inflation are pointing down. It's really a case of how quickly will the inflation rate come down, to what level will it settle down to, and then commensurate with that is at what point will it be enough for the Fed to reverse course in this tightening cycle and do the pivot? Those are the key questions.
I hear you on commodity deflation, but something you also said to me, I think it was the last time I interviewed you, was don't give up on gold yet. And of course, since that CPI print that surprised to the downside, we've seen a massive $175 rally in gold. Certainly, it's an eye-opener in terms of technical analysis. Do you think that's going to continue? And is it seems to me, on the one hand, if you think inflation's rolling over, maybe that's a good sign. But on the other hand, it sounds like you don't agree with the consensus that thinks the Fed is about to pivot on rates. So maybe this is a false start. What do you think?
Well, interesting. I think that what's happening at the same time as other central banks are playing some catch up to the Fed. Christine Lagarde is sounding quite hawkish. The ECB is going to continue to raise interest rates, possibly long after the Fed presses the pause button. And of course, the Fed had a head start on the ECB and the Bank of England. And they, the sterling and the euro comprise such a big chunk of the trade-weighted U.S. dollar index. On top of that, the Japanese authorities have made it very clear that they have drawn a line in the sand, and so far successfully at around 140. And of course, just to get the DXY right, you get those three currencies, and Bob's your uncle. So I think that the U.S. dollar, and also keeping in mind that it is the most overcrowded trade in the Chicago futures and options pits, the long U.S. dollar trade, which has worked so well for so long, it's still the largest net long position you'll find on anything in the commitment of traders reports. So I'm of the view, and having been a dollar bull, that the dollar is topped out. I say that 100%, that even with the Fed still raising rates, but I think they're getting towards the end of the rate raising cycle. I think it'll be over by the beginning of next year. And these other central banks will still be raising rates, at least for a while, and those interest rate differentials will work against the U.S. dollar. And gold is priced in U.S. dollars. When everybody was complaining and lamenting and belly aching about how badly gold was performing, I would say, well, look at gold in yen terms, look at gold in euro terms, look at gold in sterling terms. It's not a bad looking picture. It's just that everything looks horrible when priced against the U.S. dollar. And look, the U.S. dollar at the peak, was up something like 15% on a year-over-year basis. Currencies aren't equities. You could tell somebody that the S&P is up 15% year-over-year. Oh, okay, yeah, sure, why not? But currencies don't normally swing like that in 1 year. It's happened a handful of times since the mid-1970s that you've had such a dramatic bull run in the US dollar. And it's wreaked havoc with a whole bunch of things, and gold is one of them. So I'm bullish on gold. I'm bullish on gold because I'm turning from bullish to neutral to probably bearish on the US dollar. And I think that in a year where we will have a global recession, we're going to have a year of accelerating global credit defaults. It will be a year where you will want to move towards safety. And gold, I think, fits that bill. And I think people are now having a second look or second thought about whether it was a wise move to treat crypto as an alternative to gold. When I kept on asking people about crypto over the years, and I was never an investor in crypto, I was an interested observer watching from the sidelines. I never felt bad about not participating. Let me tell you, not for an instant, even when it was going asymptotic north. But people always said to me, well, we know what the physical cap is on Bitcoin, and we're just using the outstanding valuations of gold to come up with our pricing metrics on crypto. And I would just say, well, if that's your valuation, why not just buy gold? And in fact, at a personal level, the last trade that I have made in my family's account have been buying Canadian gold coins. And I continue to do that and store them at the Mint in Ottawa. So I am actually turned very bullish on gold. And I think that at least for the next year, maybe the next few years, it's going to have its day again as a hedge against the US dollar. The Fed will be cutting interest rates at some point that will benefit gold as well, although that part of the bull market in gold happens later. But we had done some work on this when crypto was surging and all of these retail inflows going into this new magic of creating instant wealth. We had estimated that the proliferation of crypto as quotes an asset class cost the gold price roughly 20%. We did work on this. So I think that a new day has dawned and a new realization. So I think that crypto's competitive features or allure after the massive instability and bear market is going to benefit gold as well as a relative asset class.
Let's step all the way out to the global picture. It seems to me that this war in Ukraine is really about a lot more than just Ukraine. I see it as the beginning of a new era of increasing conflict between the global superpowers, between the United States, Russia, and China. Would you agree with that? And if so, oh boy, what are all the implications and consequences of that for investors?
Yeah, and I think that, you can count in some other countries as well, that didn't play ball with the U.S. You can count, India as one of these countries as well that is, at least, cozied up. Of course, India receives most of its armaments, its arms shipments from Russia. And then, of course, there's the frictions with Iran and frictions with Saudi Arabia. But you're right, it's become a different sort of a world order than what we've been accustomed to. It's back to some form of a Cold War. It's not a nuclear war, but I think that we're certainly going into a future where there is less cohesion and more friction between two economic superpowers. That friction is not a new story, but it's an evolving story. And of course, the economic and technology warfare between China and the United States is going to continue and will have its own pernicious impacts. The Russia situation is only important in the sense that that Russia is such a huge commodity producer and exporter. And so that produces its own level of complexity. And we have to come to grips and do a lot more work on what life is going to be like for the world, not just with this polarization between China and its allies, and you can include Russia and the United States, but also what is life going to be like without Russia being part of the new world order or new world economy, because even after the situation in the Ukraine gets resolved, insofar as it ever does, Russia is going to be viewed as a pariah. So the Russia-China alliance is probably going to continue. They were cozying up even before the invasion of the Ukraine. And it's going to have a lot of implications. I think it puts a floor, notwithstanding the fact that I was saying that there's a cyclical bear market in commodities coming from the demand side, the floor underneath the commodities sector, which means that prices would probably fall a lot more without the supply side constraints under the conditions of a global recession. It means that the floor under commodities is going to be a lot higher. Probably means that basic materials are things that you may want to buy on dips from a strategic standpoint, and that includes oil. I think that we come back to the comment on gold being a classic hedge against geopolitical instability and the situation with Russia and China. And again, it's not just Russia and China. There's also, we have to consider the Middle East and Saudi Arabia and I don't know if hostile would be an overreach, but we've seen a much different approach from the Saudis with the Biden administration than certainly with prior administrations. All of this tells me that we are going to have a longer period of supply constraints on the commodity space. And that's probably an area that you can dip back into first before equities.
You said earlier that you thought the only thing that could restoke inflation would be if there's some other kind of global supply chain shock or something similar to that. One of the things that some people are beginning to predict is that this bifurcation of the global economy, where we used to have NATO versus the Soviet Union, maybe it's going to become the NATO alliance versus the new BRICS Plus alliance. A lot of people are saying that will require reshoring of critical industries that we now depend on Asia for and moving it all back to either the United States or other Western countries. Is that by itself a big inflation shock? Seems to me it's not going to be cheaper to do things in the U.S. than farming it out to Asia.
Well, it's not a shock since it's already known and it's already taking place, whether you want to call it onshoring or nearshoring. And this has also has the thumbprints of COVID and the implications that had on global supply chains. And of course, how China has handled its pandemic over there. God forbid you get a handful of COVID cases in a cities, port cities that are critical supply chain areas get shut down with tens of millions of people as residents. That's problematic. But you're quite right. That's not really an inflationary shock. The onshoring, if you want to call it deglobalization, and it's not going to be total deglobalization. It'll be partial. And it does end up making the global cost curve higher than it otherwise would be. But these are very glacial moves. When push comes to shove, inflation peaked in 1980. And of course, it did have some help from oil prices coming down from their all-time highs at that point at roughly $40 a barrel. But you had Paul Volcker as head of the Federal Reserve, precipitating two recessions back to back. And that paved the way for confidence that inflation was going to come down. Now, I talk about 1980 because, when you really think about when did the Berlin Wall fall? It was basically almost a decade later, when we brought Russia into the world order. When did we have China make its ascension into WTO was in the year 2000. So the point I'm making is that inflation peaked and was coming down 10 years before the Soviet Union collapsed. Inflation peaked and was coming down in the 20 years before China's ascension membership to WTO, which unleashed greater rounds of globalization. So inflation is a very complicated process. Dozens, if not hundreds of things go into the formula. And when you're talking about onshoring, nearshoring, doesn't help my inflation view, not a bit. However, it's way overstated. And its impact on inflation is not a shock. It's glacial and will occur over time. And then there's other offsetting factors to that. For example, who are the big beneficiaries? And it's not as if everything's coming to the United States. A lot of the production from Asia is coming into Mexico, which is a low-cost producer. And I think what's going to come to the U.S. is going to be more in tune with what's deemed to be in national security. So you'd be talking about medical care products, and you'd be talking about semiconductors. That's already starting, but a lot of the production will move to our NAFTA amigo to the south, which is Mexico. So it's not going to be as pernicious a global cost move. It certainly will add to cost pressures over time. But again, you're talking about something that you're going to measure over decades, and it's going to be glacial. And although it's not something I would put into the checkmark column of David Rosenberg's disinflation view, it's in the other column. There's other things going on. Aging demographics in the industrialized world is a deadweight drag on pricing power because it means slower aggregate demand growth. And all the while, when you think about what COVID did, COVID brought a whole generation of people like me in their 60s into the world of technology. And that technological advancement, that was part and parcel, I guess, if you're looking for any silver cloud, it is how more digitized the economy's become. What that means for productivity is going to be an offset to, this deglobalization move. So when people talk about deglobalization, I say, yes, I get it. It's one factor amongst a myriad of factors that you have to take into account when you're discussing inflation. But it's not the only factor. It's just a factor, I think, that will not cause me to change my view, something to be aware of. It's something that can slow down what I think will be the inevitable mean reversion towards lower inflation. And I'm trying to just make the point yet again that the whole globalization trend, took place long after inflation had peaked in 1980. Just the lesson that you have to take a very holistic, eclectic view towards inflation. You can't focus on just one thing.
We're getting more and more hints that China reopening may be coming, and it's probably more likely a Q2 story than a Q1 story, but sooner or later it's coming. Seems like everybody agrees that it's a big, meaningful event for the global economy, but everybody has a different version of what it means and what the impacts will be. What's your take?
Well, my take is, how does anybody know what Beijing is going to do or not do? There is this view that the protests were significant, and perhaps enough to cause Xi Jinping to start to rethink this very aggressive COVID-0 policy. I could buy into that. I could buy into that view that the events that have happened, the latest wave of COVID case counts, which went to a new record, was like taking sour cream and then making ice cream out of it, because what comes out of the other side is a realization that, as we saw in the United States, different level of protest, mind you, but that it did ultimately have an impact on the political decision making. It could well be that we end up seeing China loosen up its COVID restrictions. I think that would be beneficial for the global economy from a demand standpoint and also from a supply standpoint. There wouldn't be any significant inflationary impacts out of it. They would just make the world a better place and would help reduce the overall level of economic uncertainty. But to try and handicap a policy shift like that out of China, and especially with somebody who basically does not have to face the electorate, Xi Jinping is in power for pretty well as long as he wants, doesn't face a sort of political pressure that a president would or in the United States. But I'll tip my hat and say, for the people out there that say, yes, this is going to be happening in the first half of next year, I'll say, okay, I can buy into that. It makes sense to me. But frankly, I would not want to be trading against. I wouldn't want to be. I never want to make big bets on political decisions. Okay. I never found that to be a very successful strategy. So I would just be happy to sit and wait to see if it actually does happen, as opposed to trying to get in front of it.
Well, Dave, I can't thank you enough for a terrific interview. But before I let you go, I really want to talk about the Breakfast with Dave newsletter, which I've got to believe 99% of our listeners are already familiar with. For anyone who's not, it's not a quarterly newsletter. It's not a monthly newsletter. It's not a weekly newsletter. It's every single day. And boy, it's been going since your Bank of Montreal days. So I don't want to embarrass you by asking how many decades that is. But something I don't think everybody realizes, because it's relatively new, is since you left working for the sell-side firms and founded Rosenberg Research as an independent entity, you've expanded Breakfast with Dave to offer other product offerings with it. So give us the update on what's there beyond the daily newsletter. And also, how about hooking our listeners up with a free month?
Sure. Well, it's a Breakfast with Dave, which has been around really with different monikers since 1998. As you said, and really put me on the map 30 years ago. It is the Big Mac, I guess I would call it, of Rosenberg Research. But we do so much more. We do a monthly publication called Strategizer, which is an active investment tool. It provides heat maps and risk-reward attributes for global equity markets. We split it out regionally by sector. We have a bond duration model. We have currencies and commodities. And we have rolled it into, just about 3 months ago, into an asset allocation model. And that's really for active investors and portfolio managers, but also retail investors like to use it as well. It's actually a very good tool, and it's all built on 1 year expected returns. And so it's called the Strategizer. I actually started that when I was at Merrill Canada back in the late 90s, early 2000s. It was always my dream to resurrect it. When I moved to New York as chief economist, it went defunct. But it does take a lot of money and a lot of capital, a lot of work, and a lot of back testing to get it right. In fact, I didn't unveil it to our clients until we were in business for a full year. Strategizer has been a home run for us, and I would say starting to rival in popularity Breakfast with Dave. But we do special reports on just about everything, political, economic, financial, and we cover the world and we cover sectors. And a lot of the ideas we get for our special reports come from our clients. Some of our best ideas come from our clients. So it's a great symbiotic relationship. And I would say the other, out of the 10 different things that we do, the webcast series, the Thought Leadership webcast series, has been a real game changer as well. And I would just say to anybody who's interested, just Google Rosenberg Research, or you can Google my name, David Rosenberg. It'll take you to the website. And it's as easy, practically, as the click of a button to get on the free 1 month trial and be able to at least taste the complete smorgasbord. And you can buy the premium package at a 70% discount, which is everything we do, or you can create your own happy meal and just pick and choose the items that are most suited for you. I'd say half our clients have the premium package and half create their own happy meal. But what we try to do is be all things to all investors. And we cover the world and we cover every aspect of the capital markets.
And listeners, you'll find a link in your Research Roundup email that connects to the free 1 month trial of the Breakfast with Dave newsletter. Patrick Ceresna, Nick Galarnik, and I will be back as MacroVoices continues right after this.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, It was great to have David back on the show. I just agree with so many of his points. It just doesn't feel like this bear market is really over, and that this rally, while there's certainly some gas in the tank on the upside, we're going to really have to see how far this goes and where the real risks are. Now, joining us again in the post-game segment is Nick Galarnik. Now, before we get to the chart deck, Eric, what did you take away from the interview with David Rosenberg?
I was surprised by Rosie's conviction and certainty that inflation has peaked. I guess we need to add his name to a growing list of MacroVoices guests who disagree with the inflation is here to stay view that we were hearing from most of our guests for several months. My absolute strongest conviction view is that figuring out whether inflation is really behind us is the single most important thing to figure out in this market. I personally had been really leaning toward inflation is here to stay, but the number of smart people disagreeing with me is definitely humbling, especially in the last few weeks.
Now let's get to the chart deck. Listeners, you'll find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over David Rosenberg's picture that says looking for the downloads. All right, let's get to these charts now. Nick, let's start on page 2. We have S&P 500, and I know you were looking at some of the implied ranges. Obviously, a bit of a breakout here with it going above its 200-day moving average. What are the levels you're watching?
Yeah, Patrick. Looking at the December 16th monthly OPEX on SPX, we have an implied move of about 150 points, with upside projected to be about 42.30, with a gap fill at 41.10, and heavy resistance at 41.20. Now, the downside projected is at 39.30, with support at 38.50 or so. Now, looking at the chart here, we can see that there could be upside as high as 42.50 or so. And given that we're in December right now and volume tends to dry up a little bit, it's possible we see a run into the end of the year here, which a lot of the bulls have been hoping for. Eric, what are your thoughts here?
As Rosie said in the feature interview, most bear market rallies have failed at or near the 200-day moving average. We moved above it Wednesday and fairly decisively, but only just above it so far. So to my thinking, this is make or break time for the S&P. If this turns out to be a fake break and we close below the 200-day moving average and stay there for a few days, that would say to me the top is in for this bear market rally and probably all downhill from here. But if this rally continues higher, I think it's probably a sign that a Santa Claus rally will continue through year end. So the jury's still out on my mind as to what's happening in the short term, but if this market's going to roll over to the downside, it needs to do that pretty darn soon. But here's what I want to ask you guys as the option gurus in the house. I really don't know what comes next in the short term for equities, but I strongly agree with Rosie that the overall bear market isn't over yet. I'm not inclined to make any huge downside speculative bets because, frankly, I'm not an equity trader per se. But I do have plenty of long-term buy-and-hold equity positions in gold miners, uranium miners, advanced nuclear technologies, and non-crypto decentralized finance. Since this might be a top or near a top of a bear market rally, I'm inclined to start laying on some S&P puts as a hedge against the broader market selling off in 2023 or maybe even sooner as the bigger picture bear market continues. My problem is that long-dated at-the-money puts on S&P futures expiring at the end of 2023 are not exactly cheap at current implied vol levels, and I have a fairly big chunk of notional principal to hedge across all of my long buy-and-hold equity positions. So what are your thoughts on more creative hedging strategies to avoid paying through the nose for long-dated S&P futures puts at these prices? Again, my goal is just to hedge the downside risk if the whole market crashes in 2023 and takes my gold and uranium mining shares and advanced nuclear and DeFi shares with it.
Yeah, Eric, that hedging topic is really an interesting one I want to dive into. But first, I wanted to just make a quick comment on the S&P. Obviously, we've been looking for this bounce to continue, and we're starting to approach levels that I at least am starting to be suspect of. The really big question for me is it as simple as everyone is thinking, which is that, we have a Christmas rally and then a bear market resumes next year. The market tends to throw curveballs and surprises surprises. And, it's I always try to ask the question, how is the market going to catch everyone off guard? And so to me, that increases the risk that either A, the market actually has a surprising upside surge that catches all the participants off guard, or quite the opposite, the sell-off, begins in earnest and catches everyone that's been waiting for an opportunity to short later in the December off guard. And I certainly am not predicting necessarily one of those, but the fact that it seems increasingly consensus the way that this kind of Christmas rally was going to be play out. Anyway, but your topic on hedging is a really important one, and obviously, Nick and I spend a lot of time thinking about option strategies and how to implement hedges in a portfolio. Obviously, staying long this market here, at least on the short term, makes sense, but having some way to protect your portfolio is important. Now, when the question is, I want protection, I want to hedge, that's a pretty open-ended question. The question is, how long do you want your hedge to be? And more importantly, what are you trying to hedge? Do you want to remove all left tail risk on a market decline where you need the hedge to build huge delta dollars and remove all downside risk? Or are you simply trying to blunt the damage that a 20% decline in the stock market would do to your portfolio? And those are important questions to ask, because the construction of a hedge is very much dependent on what you're trying to hedge. Now, with that said, I would personally be taking a look at this from a perspective of using a debit spread hedge. The view here is that if the stock market was to turn down a 20 to 25% decline down towards the 3,200 to 3,000 level would be realistic downside target if there was going to be another leg of a bear. And therefore, one of the interesting considerations that I was put on is that, well, why not then potentially put on just a pure put debit spread on the SPX? And an example of that, if you just go to the first quarter of the year out to the March expiration on the SPX options, doing a 500 S&P point wide debit spread between, let's say, 3,700 down to 3,200 can be open just under $50. So, if that came in a big way, you almost have a 10-to-1 payoff on it, and it doesn't cost you a huge carry to have this put protection on. This would massively blunt the damage done on a bear leg on if you did have a series of long holdings. And so that's one of the ways that I would approach it. But Nick, I know you take a much more active approach to managing these kinds of hedges. What kind of a hedge would you construct for a first quarter risk?
Yeah, it's a great question to ask. And again, I always like to ask the question, as you said, what is the timing of your thesis, as well as what is the magnitude you expect on the downside, perhaps, for a hedge? There are many ways to trade this, right? You could use SPY or SPX, SPX being the better one, I would say, in my opinion, because it's cash settled. You could use variations of ratio spreads or butterflies. But to keep it more simple here, I would say the best way that I see to hedge would be to look at your portfolio, analyze what you're holding, and determine how much pain you'd suffer on a downside correction of, say, like 10%, 20%, and then from there, build out your strategy. I prefer to go with about 60 days out, so somewhere around January timeframe versus the March, as Patrick suggested. What I would look at perhaps is downside to the lows of 3,500, possibly below that to 3,200, as Patrick said as well. And I would also go with put spreads using SPX. So looking at the option chain, if, for example, you wanted to do something like this, you could go with January 20th OPEX, the $3,500 puts long down to $3,200 on the put short right there. The net cost of that trade would be only about $580 per position. So your upside there would be about $29,500 for $500 risk, roughly, on that position, right? So you're risking basically $500 or so with upside of almost $30,000. And again, this is a hedge. It's not meant to be a payout where you're trying to make a profit on this trade, right? You're hedging your portfolio in aggregate using a hedge.
What makes that interesting, to cut you off here, Nick, is this idea that, you could, when you're doing such a low cost left tail kind of hedge, you can always throw a call credit spread on the markets up above and use the proceeds to net that cost down to almost zero. Is that something that you commonly do?
Absolutely, yeah. I was going to actually add that too. So awesome minds, right? But looking at way above right now on SPX for January 20th OPEX again. So for example, as Patrick, as you just said, if we were to sell the $4,500, for example, call option on SPX, and say we were to buy, for example, the 45.50, which is a 50 wide credit spread on SPX, you're getting a credit of about $3 right there almost. So you're reducing your debit on the put side from about $5.80 down to about roughly $3 or so. So you're reducing your overall cost on the hedge a little bit more. And again, the whole idea here is that if we push to the upside of 4,500, well, that's an upside of an additional 10% from here, which means your portfolio should see gains as well. So you're not too concerned about that move to the upside. And remember that SPX is cash settled, so you're not worried about assignment risk whatsoever. So that's how I would play it probably is, again, as we said, a put spread out of the money on the downside and financing that with a credit call spread way out of the money again on the upside for the January OPEX. That's how I would play it.
Yeah, what I think we should do, Nick, is maybe in next week's episode, we can elaborate on the idea of using something like a butterfly as a hedge, as an alternative. So, there are all sorts of different ways to approach this. But the key, actually, I think, is the fact that right now we are at multi-month lows of volatility right along the bottom of the range. And so it is actually a particularly interesting time. It's not that volatility is super cheap or there isn't vega risk, but it is, at least from a volatility perspective, some of the cheapest conditions we've seen in many months. And that at least is an interesting consideration that as we get further in this, it becomes more and more interesting to actually hedge that way. Actually, we might as well just comment on that, because on page 4, I do have that VIX chart. You can see that reapproaching those April and August lows pretty much right near the bottom of the 2022 range on the VIX. What's your thinking here on the VIX?
Yeah, so we've seen a lot of calm in the VIX the last few weeks, which is pretty surprising, right? We're pushing down near support at 20. As we've seen over the past year or so, when we've hit these lower levels back in late August, early September, and then also in April, we've bounced off pretty fast and those have coincided with declines in the overall broad markets, right? So remember that when the VIX is at 20, the average daily move on SPX should be about 1.25% or so, right? So we're not seeing a lot of volatility on the downside anymore. We're seeing gradual ticks to the upside. Yesterday being obviously a little bit anomalous because Powell spoke. But that being said, even on days of decline, we've seen the VIX go down as well, which is very, very strange.
Yeah.
So,
well, what's interesting about that, Nick, though, is that we actually have some interesting things coming out. Everything from in the next 3 weeks, we obviously will have a jobs numbers coming out tomorrow. We have basically an inflation number coming in the middle of the month, as well as the next rate announcement from the FOMC. And so there's room over the next 2-3 weeks to actually at least have news headlines that could drive big, at least swings in the market on a short-term basis. And volatility is not really picked up in that. So it'll be really interesting to see whether that develops new opportunities. But Nick, just circling back to page 3, we had that chart on the NASDAQ. And this time I put on the chart on the QQQ because I know that's where you analyze the levels a little bit more. What are the implied ranges on the NASDAQ?
Yeah, so looking at the NASDAQ right now on QQQ, expected moves for December 16th OPEX is plus or minus 14 points. So upside projected is 308, which is near the gap fill at 310 or so. And just to note as well, yesterday's close was the highest close we've had since the second week of September. So interesting to note that as well. Now for the downside projected, we have 280 area, which is heavy support. So remember that tech usually runs or drops harder than the broad market overall, right? So, the S&P will drop, for example, 1%, and the NASDAQ might drop 1.5% because obviously a lot more volatile names are in the NASDAQ as well. So I'm thinking, again, as I said before on the S&P, I think we see some upside in the short term on NASDAQ, especially because we've broken the recent short-term highs, right? Upside to 310 or so would not surprise me whatsoever. But again, the bear market is probably not over, so I'd be very cautious as we reach those levels. Now, we've already gone over the VIX, so moving on to page 5 on the dollar. Eric, what's changed in your thinking here?
Well, the move down on the Dixie transitioned into a sideways consolidation between 105.5 and 107.5 about 2 weeks ago. Now we're testing the bottom of that consolidation range. I'm watching for a daily close below the November 15th bottom. Absent that, we're in a sideways consolidation. I have no fundamental view on what happens next. I'm just watching the chart and waiting for it to tell me which way the market wants to go from here.
It's interesting the way this consolidation's been happening, Eric. Like the dollar just obviously has been just correcting after having an extraordinary bull run through since the start of the year. When I was having a conversation earlier with Nick, we were pointing out that it's actually even attempting to break down below the 200-day moving average on this on the dollar. But I think when David was sharing with us during his main interview that the high of the dollar is in, I asked the question, well, sure, maybe that level may actually end up in the bigger picture being a high, but often we see retesting of highs or topping formations establish themselves. And with us going into what could end up being a very difficult 2023 year, us seeing a period where the dollar can have another leg higher, at least to at minimum retest the highs, is something I don't want to take off the table. And so while certainly it's been a bit of a correction and we're testing key levels, I still want to kind of keep a close eye to see whether or not that US dollar can start another bull run going forward.
Now on page 6, we have a chart of gold. Eric, what are you thinking on this breakout?
The last time we talked gold 2 weeks ago, I said to watch for a retest of the 100-day moving average at 1720, and I said that was the place to add to longs. That worked out perfectly, almost to the tick, and I added to my longs right there. But let's not lose sight of how we got here. To my thinking, the whole $175 rally to new highs, or at least recent highs, I should say, was brought on by the November inflation miss. Let's not forget that CPI is a famously noisy series. And despite Rosie's conviction in the feature interview that inflation has already peaked, I don't rule out the possibility of a higher print when this month's CPI comes out on December 13th. If that happens, you could see this rally reverse as quickly as it started. On the other hand, another below consensus print on December 13th could rocket the market even higher. So let's wait to see what December 13th brings before we finalize any view that a new bull market has begun. But so far, all the signs are looking pretty good.
Well, one of the things I'm thinking here, Eric, is that that gold with this breakout, it's following the playbook in terms of U.S. dollar weakness, general risk on in the broader markets, and gold has actually been behaving far more like these cross currencies than they are into some of the commodities which are struggling. This currently, in my mind, has upside targets towards 1900. Whether we actually achieve 1900 is, I'm not a super certain of at least on this impulse, but move to 1850, 1875, where the highs of May and August were, I think is a very reasonable short-term target. What certainly is happening is after the gold market just being bled out, lower highs, lower lows, just systematic distribution for almost 9 straight months. Finally, the tension is back here, and it's at a time when crypto is not really working. And so it'll be really interesting to see whether or not gold will continue to build on this as we move forward, or whether or not there will be risks in the new year.
Okay, well, finally on pages 7 and 8, we have charts of the junk bonds. Patrick, what are you watching over here?
Well, to me, this is a really interesting area. Like, we keep talking about the 10-year Treasury yields, and obviously, if David is right and disinflationary pressures do emerge, maybe bonds have bottomed, and maybe we do have a chance that there could be a rally. I mean, those are things that we're going to continue to watch closely in the coming weeks and months. But the interesting thing for me is that if the bonds do rally, but the recession becomes a real risk, then we should see it start to reflect in finally credit spreads widening. So on page 8, I have the actual high yield credit spreads on junk, and with high interest rates and usually shorter durations, inevitably these junk bond companies, these high yield companies, will have to be either refinancing at higher interest rates and ultimately come under duress, which could increase default rates and certainly the premiums that are being commanded in this space. Now, up throughout this first 2022 part of this bear market, credit spreads have not been blowing out. While we have seen a widening to 6%, those are not the kind of blowouts that we see typically when corporate credit gets under stress. It usually approaches 9-10%. And so therefore, the canary in the coal mine for me going into the new year is if and when these credit spreads and subsequently junk bonds start to diverge from the main bond market and start to really show that something underpinning is actually happening. Because if we start seeing junk bonds and corporate credit under stress, almost certainly it has a very good chance of causing stress in the stock markets. And that could be really where, again, like the canary in the coal mine could end up being for a turn in equities. And so that's certainly something to keep an eye on.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview, as well as a link to the chart book we just discussed in the postgame, and a link to a number of articles that we found really interesting. So you'll find this and so much more in this week's Research Roundup.
Well, that does it for this week's episode. We appreciate all the feedback and support we get from our listeners and are always looking for suggestions on how we can make this program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases, and also follow Patrick at Patrick Ceresna. On behalf of Eric Townsend, Patrick Ceresna, and myself, thanks for listening, and see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.